Hello and welcome to Find Your Freedom, a podcast dedicated to helping you truly find freedom in all aspects of life. Join your hosts and their expert guests as they share practical tips and strategies for finding more freedom in your life. It's time to take control of your life and create the future you want. Let's find your freedom. Here are your hosts, Lenny the Boss and Omid Rad Investor.
Boom, boom, boom. We are back with another episode of Find Your Freedom, and we have a really good episode today. We can't wait to deliver this one to you. But before we start, just to let you know that this episode is being brought to you by Wealth Builders Mortgage Group. They can help you with short-term rentals. They can help you with long-term rentals. They can even help you purchase your own home. So I'm telling you right now, I use them. Omid used them. They are fantastic, easygoing. Whatever you need, make sure you go to Wealth Builders Group. All right. So today, we're just going to talk about a popular loan product, and that's called DSCR loans. And we have a guest here, Nathan Gort. I got that right, Nathan Gort? All right. Oh, I messed that up. Sorry, dude. And he specializes in this, so he's going to share all the good, all the bad, and all the ugly when it comes to these type of loans. So, Nate, what's up, man? How you feeling?
I'm feeling good. Happy to be here.
Happy to be here. Listen, we're happy to be here too. Look, let's just jump right into this. So what in the world is a DSCR loan? What does it stand for? Why should people even use it?
Oh, that's a simple answer. DSCR stands for Debt Service Coverage Ratio Loan. It's basically a residential mortgage, kind of like commercial, where all you care about is the performance of the property. So if the property pays for itself, it's pretty much approved. You can even do less than 1-to-1 ratio for those that do not short-term rentals, but short-term financing, where you're going to buy a property, you're going to fix it up over the next 12 months, and then you want to refi. You can do a less than 1-to-1 debt service because it's treated like a bridge loan. And so investors love it because, well, you said keep this one short. There's several benefits. I'm sure we'll get into it. But DSCR has, over the last, I'd say 4 years, become a very popular tool, as many investors have hit different roadblocks throughout their career, and DSCR has been a good solution for them.
And I've got to give Nate some credit here. So we do some DSCR loans as well, but Nate definitely helped me as we started doing DSCR loans. He was very instrumental in helping me understand some of the ins and outs. And I still call on Nate sometimes to help me with situations. So Nate's awesome. I just wanted to say thank you. Really appreciate you. And he knows his stuff.
Boom.
and I see the sign up there. It says DSCR GOAT. So, I mean, you're the guy. So how did you transition into being the guy for this particular product versus any other product?
Oh, that's a funny story. So when Parker came on board with Movement was when I was exiting. I started my career at Movement. I did a couple of these loans for clients that wanted to invest. And truth be told, I kind of got a lot of backlash for it at our company because we didn't really do them at the time. Movement didn't. And so I made a move to a company that was going to allow me more freedom. But every once in a while, the grass is not always greener. So I was with that company competing against another company. And weirdly enough, found out that company, with all the promises, I think I was there 6 months, they weren't really investor focused. And so I called up the guy I was competing against, who's one of the owners of the lender. I said, hey, I'm interested. Let's do this. And since then, I've never looked back. And it's been a blessing because for me, you said you want to see emotions on here. I'm not an emotional guy. You asked, I cried. I can't remember the last time I cried. But for me, investors don't get emotional, right? It's numbers, it's factual, it's this. And I'm like, that's who I am. If you want a hug, okay, I'll hug you. But all this, hey, let's celebrate first time home buyer. I bought my first house. Let's hug and jump and take photos. That's not me. So I switched for investors because that's my clientele. And I've absolutely loved the time period that I've been with the company, and investors get it, right? If it cash flows or makes you money, you buy it, right? Where emotionally, for first-time home buyers, is the cabinet the right size? Is the color right? I went to be less emotional, I guess.
Okay.
That's awesome.
That's
So
awesome.
so with the debt service coverage ratio loans, I know, so we look at, of course, the property, the projected rents versus the income of the property. And then, of course, credit, somebody's got to guarantee the loan, and cash to close, which I feel like is a little more flexible with this product than some others. What are some of the downfalls that you've seen with this product?
So let's just get the number one downfall out of the way, which is going to be a prepayment penalty, right? People get scared by the term prepayment penalty. One, a lot of people just don't understand what it is. A lot of people have this myth that, hey, I've got to pay a payment penalty on the lump sum, like for the whole term. No, it's not that way. It's a fixed amount at the beginning, and people read the contract and they're like, oh, it says my prepayment penalty is 35 grand. Well, that's if you were to pay it off today before your first payment, but it decreases over time, right? And the other thing that it just scares them because they don't know what's going to happen in the future. And again, emotional versus unemotional investors who don't take emotion into it realize, hey, there's a good chance it doesn't make sense to refi in 2 or 3 years, right? I don't want to pay my closing costs again. The prepayment penalty is almost a, what do you want to call it? A safety net that says, hey, I don't want to pay that penalty. I don't want to pay the fees again. So to me, a lot of investors use it actually as a benefit, but that's the number one downside to DSCR loans that I see everyone talk about. The other is going to be they usually cost more money, right? Because it's not backed by an agency, so you have origination costs usually, or you take a higher rate. But again, that is the second biggest complaint we see. But what other people don't realize is, unlike Fannie and Freddie, DSCR loans allow you to take up to 9% seller concession on an investment property. Fannie and Freddie are 2%. So there's always a negative, and it always takes someone to show the positive.
Can I interrupt you there? Can you explain 9% versus 2%? So what does that even mean? So let's just say I buy a $1 million property. How does that translate into the closing costs?
Absolutely. Great question. So usually closing costs is a certain percentage of the loan, right? It's prepaid taxes, prepaid interest, I always say this wrong, tax stamp transfer fees in states. It's all your prepaid costs. It's everything besides your down payment. And so 2% doesn't really cover that much, right? 2% of $1 million is not much compared to what your closing costs are. So
sorry, let me interrupt you here real quick. You're talking about what you can ask the seller to contribute.
Yes.
For you. So that 2%, 9%, you're talking about seller covered closing costs.
Yes. Okay. So for me, I love the fact that unlike a lot of loans, you can prepay HOAs for 3 years with DSCR loans, right? That's your biggest, especially Nashville, Tennessee, right? Those HOAs are ridiculous. Why not get part of the seller concession to pay for 3 years of HOAs up front and increase your cash flow for those 3 years until you think you might refinance again?
All right, hold on, man. Let's take a step back. Because we're hitting a topic that seems very, very, very interesting. All right, so let's call this guy John. Right? John knows nothing about anything, but one thing John knows is he wants him an investment property. Now, John, he makes, let's say, $75,000 a year. He owns his own home, and he found a deal where it falls perfectly for this because he will make more money than what the debt on a property will be. So with that being said, John is at the negotiating table as we speak. Okay. And what should John be asking for from the seller? John's the buyer. And what should he be asking for from the seller? And can you kind of tie that into what you just was saying? Because I think we gotta put a story to this.
Absolutely. So I would say seller concessions is the number 2 thing. First, always ask for financials of a rental property. Drives me nuts when buyers don't ask for that because actuals are usually going to be your better than any, comps that say what the income could do. So it drives me nuts when investors don't ask for financials of a current rental. 2, your agent, investor-friendly agent, is going to know how to negotiate seller concession. If you have $1 million property and you want to offer 50 grand less, it's better to ask for 50 grand worth of closing costs than it is to reduce the price of the property, right? There's a little equal point, like how much lower can you get it for versus seller concession. And that's where someone like Parker or any lender out there can show you the difference. Like, hey, if you buy it today for $1 million and you get the seller to pay all your closing costs, right? Which is anything more than your down payment, all the lending fees, the prepaids, and all that stuff. And now today you might have to pay your buyer's agent comp, right?
Right.
So you have to look at seeing what's more beneficial for you. For me, most of the clients I work with, it's more beneficial to take 6% seller concession where you, the buyer, only come in your down payment. Down payment means that money is applied to your equity, where if you do cash to close, that's part down payment and part fees, which doesn't go to your equity. So I'd rather pay all money to equity, and then that way all fees are paid for by the seller. Plus, in the back of my pocket, I always remember if I'm going to refinance in 2 or 3 years, I'm okay with doing that because I didn't just pay fees 2 years ago, right? That sucks to paying fees twice because that hurts your cash on cash return. So right now, with the way the market is, there's a guy on YouTube that says now's the time to make insulting offers. Why not offer lower on a property and ask for max seller concession? It's part of the negotiation game.
Mm-hmm.
Okay. And you're saying max is 9%.
DSCR non-QM loans allow 9% on new construction, 6% on existing. The 9% for new construction is big because you might negotiate, hey, I'll pay a higher price, right? I'll pay you the $1 million, but I want all the appliances in there. Or, hey, you have an HOA. This just happened in Nashville. His HOA was $425. We paid for 3 years of HOA dues up front, and that increased his cash flow for 3 years.
Mm-hmm. Yeah.
So can you explain? So I'm an investor, and let's just say my debt to income ratio is not great. What is like your typical like how are the rates maybe different than like a traditional loan, and when is like a DSCR maybe more appropriate as far as leveraging the product?
Absolutely. So this is where I think Parker and I sometimes will battle at each other. But when is it appropriate?
Yeah.
It's appropriate whenever it meets your goals, right? If it meets your goals, it's appropriate. DTI, you're overextended. Hey, welcome to the club of investing in real estate. We all are, right? So DSCR doesn't care about your debt to income ratio. It cares about the performance of the property. It cares a few other things, right? Like Parker mentioned earlier, your credit. It cares about you having the down payment. You want to make sure that you've owned a home in the last 3 years, right? Because there's a lot of mortgage fraud out there. So first time home buyers, it's very hard to do these with because there's a good chance you're just going to move into it. But for me, if a client says the words, I want to close in an LLC where it's on the promissory note, I don't care if it's their first investment or their 100th. I'm going to recommend a commercial loan or a DSCR loan because both those loans will put your LLC on the promissory note. Where I know Parker and I have had this discussion several times. Fannie and Freddie will let you transfer, right, to an LLC, but does that give you the same benefit and goal and strategy that you have set up? That's where you have to work with someone who is experienced, like a Parker, like myself, like other people that don't just what's the saying? Walk the walk, talk the wait, we don't walk the walk, we talk the talk because we are investors and we're in this space. So it's a little different coming from us than a 1-800, call.
Go mortgage. Hey, let me ask a quick question now. You're saying this promissory note, okay? Let me make sure I'm understanding what you're saying, because what I think I heard is making this product even more fancier. So are you telling me, and I'm going to do a worst case scenario here.
Okay.
You're telling me that if you say, hey, Nate, I want this $1 million property and I'm going to put it in an LLC and the note is going to be there. And if I happen to default, as in stop paying the mortgage, will that reflect on my personal resume, or would it not? Because I'm hearing that you're saying that the note can go into LLC. So if that's the case, that's telling me that it will not fall back on me at all.
So that is a great point that a lot of borrowers and investors have always questioned over the last couple of years. And most assume, right? What's the old saying? Don't assume anything. You'll make a you know what out of yourself.
Yep.
So you brought up a question that DSCR can go either way, right? DSCR on the promissory note, it's called non-recourse. It's very hard to find those loans. They're very, you won't find them.
Expensive.
Right?
They're expensive.
Yeah, they're expensive. It's a higher down payment. It's a higher rate, but you're 100% correct. There's no recourse. It's all on the LLC. People who invest that way usually are investing with IRAs, self-directed IRAs, and buying for their retirement. What we're talking about DSCR for the promissory note is what most people fear, which is if I want to buy a primary home 2 years from now or 18 months from now or whatever, I need a way to remove it off my debt to income ratio. And Parker, correct me if I'm wrong, it was September of last year. Freddie came out and matched Fannie Mae's guidelines and said you can no longer omit a rental property out of your debt to income ratio unless your LLC is on the promissory note or someone else, like if Parker and I partnered and Parker's name was on it, technically, but that has to be on the promissory note. And the only way to get that on the promissory note is at time of closing your loan. So if you want to try to omit it versus try to offset with your tax return, which let's be honest, most of us investors, my tax return looks terrible for my LLC because I'm losing money because I'm taking the tax benefit. So omitting is an easier way, which is only done through the promissory note, which is why at the end of last year, you saw a huge increase in refinancing because a lot of people who bought second homes over the last 3 years realize, hey, I can no longer omit that. And I'm taking losses each month or each year on my tax return. I want to refi and put it on my LLC on the promissory note. But you are still personally guaranteeing it if you are at least 25% or more owner of the LLC.
Now, I have a couple contrapoints here for Nate. So a couple things in my opinion. So number one, I mean, I know you asked about the rates and how do the rates differ. Actually, what's interesting right now, I'm sure Nate, you're finding this too. Really, the only downside, in my opinion, to DSCR versus conventional is the 20% versus 10 or 15. But rates are actually pretty comparable. I know Nate talked about prepaid penalty a little bit. We both have options with no prepaid penalty. So there are options with no prepay penalty, or you can do a 1 year, 2 year, you can kind of go to your comfort level there. Of course, the rates get better the higher the prepay penalty. So anybody out there who's investigating DSCR loans, definitely ask about those options. And rates really aren't that bad right now. So a couple of things there. Now, as far as the holding it in an LLC, I do like that option of the DSCR for clients to be able to close in their LLC. If you do a conventional loan or any other loan product where you don't close the note in your personal name, then you can transfer title later on to an LLC, but the note will stay in your name. And so that's that conflict. So you can still enjoy some of the asset protection with transferring to an LLC, but the note will stay in your name. Versus if you do a DSCR, you can actually close the note in the name of the LLC. Now,
so Parker, real quick on that. So you're saying, make sure we clear for his listeners.
Yeah.
You're saying if you go with this DSCR loan and you go with it being in the LLC, that it will not show up on your personal credit report.
Well, all right. So Nate and I think are aligned here. So here's the deal. It shouldn't show up on your credit report.
Okay.
But it could. It's possible. It depends on who the servicer is and how they report these things because you're still a personal guarantor. That being said, though, whether or not it shows on your credit shouldn't be what determines if it counts in your debt to income ratio. So if for some reason in the future it ever showed up on your credit report, you could probably ask for it to be removed. But if they wouldn't, you're trying to buy a home, all you should need to do with an experienced loan originator is provide a copy of the note to show, hey, this is in the name of the LLC. And then like Nate was talking about earlier, you can omit it from your debt to income ratio because you show that the LLC is holding the note.
Okay. Because I know on a credit card, right? So you got some business credit cards that will not show up on your, personal, but you got some banks like TD Bank. I'm gonna tell you, if you get a credit card through them, a business credit card through them, it will show up on your. So are we saying that with the lenders, depending on who the lender is?
No. It doesn't matter who the
This
lender
getting
is.
interesting.
Yeah. So, well, and here's the thing with a credit card. So, also to that point, though, if you have a business credit card that's being paid by your business every month, if you show your mortgage originator 12 months of that being paid out of the business account, even if it shows on your credit, we don't have to count that in your debt to income ratio because we can show the business is paying it. So, kind of the same thing with this mortgage, but oh man, lost my train of thought there. So it's not about the lend. So if Nate, back me up here, tell me if this sounds right to you. If any lender, myself, Nate, anybody else ever guarantees you that a DSCR will never show on your credit, they're either lying to you or they don't know what they're talking about. One or the other. We'll give them the benefit of the doubt and think they don't know what they're talking about. But what happens is these DSCR loans get sold to investors, and then different servicers service the loan. And it's those servicers that report. So it has nothing to do with the actual lender who originated. It has to do with the servicer it ends up with. Is that right, Nate?
Yes, ultimately, which is why every time you get a phone call, you get people that will say, hey, I want to make sure that the servicer is going to mail out my statement, I don't know the number, but for tax reason, they want to ensure that it's going to be written to the business, not to the person's personal name, which goes a step further. And just to give you an example, Lenny, like I love guidelines and I read them. I had a rental house I was flipping that I was doing the BRRRR method on. It's a house hack, actually. And for 12 months, I did the old guideline, which was just pay for your mortgage statement from your business and you can omit it. And then in October, when I went to get pre-approved to offer on another rental, because we're looking at building some spec homes right now, I literally just read that day, the new guideline update. And I just said, wow, I just shot myself in the foot for 12 months paying out of my business, my house hack, because I can no longer omit that because it was closed in my personal name. So that is a personal example myself of how the old guidelines were great. And then the new guidelines stopped me from doing the old guidelines. And that came into play, I swear it was September, October of last year. So now the new guidelines, which of course can change down the road, it's all about the promissory note. And that's what we're talking about. And so if it reports on your credit, it's great, grand. I really don't care because I can always omit it because I have the promissory note. Now, it also gets into the fine nitty gritty of the loans is how's the LLC set up, right? Like if the LLC is a sole member and you're a sole member, you use your personal social, that's one thing. If you're a multi-member, five people LLC, right, there's a likelihood that's not going to show up because there's 5 people. So what you see now, a modern trend you see a lot with short-term rentals over the last couple of years is you partner. So if the 4 of us were to go on a loan, want to buy a rental, usually, we're all 25% owners. That means all 4 of us have to personally guarantee it. However, a lot of people have read the guidelines or talked to experts and realized, hey, let's put Nathan as 75% owner, the rest of us below 25. That way the personal guarantee technically is only signed by me.
Right. Let me just ask one more thing, because we're talking like some things that honestly I don't even have clarity on. So if we had a new person, because there's going to be a lot of new individuals who's jumping into the market, what are the questions they should be asking? This probably for both Parker and Nate. What are the questions they should be asking to know that they are sitting with a good lender that's going to walk them through this process the right way? Because I'm gonna tell you, all those things you just mentioned, I never asked a question of the first of any of those things. And truth be told is, if I was buying a property tomorrow, I would not be asking any of those things either. So let's just help the new person and the old person here. What are some questions at minimum they should ask?
You want to go first, or you want me to hit with the basic? The basic one, like we'll both qualify, so I'll say it first because it makes us look good. The first question I think you should ask is, hey, do you own any rentals yourself? Right? Like, how is someone who doesn't own a home or own an investment going to give you advice? Is it possible they give good advice? Yes. But I truly believe it's a much better experience process if you ask someone, you call up Parker and say, Parker, I'm a new investor. I want to make sure I'm with the right lender. Do you own rentals? If she says yes, I don't care how many she has. I don't care how much she makes off them. I just know that she's not going to put me in something she has not done herself. That's question one, I believe.
Okay.
Yeah, that's a great one. I think that one of the key tells to whether you're talking to the right lender or not actually may not be the questions you ask them, but the questions they ask you.
Oh.
You want a lender that really wants to know what your goals are, what's your future goals, what are you planning to do, what is your down payment you want a lender that's asking you those questions. And I know Nate's asking his people these questions. So that's the number one thing I would look for in a lender is what are the questions they're asking to help you.
Okay. There you go.
So can I get a little bit of clarification? Because I'm sure there's going to be an investor that says, I don't have an LLC. Can I get a DSCR loan without an LLC? And are there differences in rates, whether it's like in your name versus in a business?
So you can absolutely do your personal name. It's perfectly okay with it. It's also one of the biggest myths out there. People say, I have to have an LLC that's established for 2 years to buy with a DSCR. No, you can form it in the process of closing, right? Mm-hmm. So you can use your personal name. You can use an LLC. There is no price difference. Some lenders might charge an extra $1,000 for legal review. It just depends how detailed your LLC is, but there's no difference in pricing, which is why, like Parker just said, ask what your goals are, ask what your strategy, what you plan to do. Because if talking with you, you say like, hey, my strategy is to build a rental empire, right? That's our goal, freedom, right? I'm going to say, let's go ahead and offer in your personal name, but let's put you in touch with someone who can set up your LLC, because the sooner you start your LLC, the sooner you're establishing your business side, which will open up another door for you, which, like you mentioned, Lenny, earlier, business credit cards that aren't personally guaranteed. You can get lines of credit that aren't personally guaranteed because you have an established LLC for 2 years is usually what the banks want. So that's the reason why I think Parker's question, I still think my question's better because I love that. But Parker's was a great one that's like, hey, ask the question what your goal is, because it might be worth, because there's no cost to doing an LLC besides paying to file the LLC. It might be a more beneficial thing for you based upon your goal. But if you're just doing one rental because you want to rent it to your kid for like 4 years, do your personal name. It's perfectly fine. But then you might want to talk, like Parker said, you want the liability coverage, quit claim to an LLC later on for liability's sake.
Yep, I'd agree.
It's pretty interesting. So to be clear, anyone can get this loan. And what I mean by that is your person. So if you work at McDonald's, which you flip burgers at McDonald's, so they get minimum wage there, right? And they looking at this property, this investment property, it costs $800,000. As long as they have good credit and they have, I guess, 2 years of work history at McDonald's.
Don't even need that.
Okay, just good credit, and they have down payment money.
Yep.
That's all they need to get this $1 million home, $2 million home.
And not a first-time home buyer.
And not a first-time home buyer. So they own their own property because they house hacking. Sure. And then they want to say, man, I see an investment property right there. The debt will be $2,000 a month and rent is going to be $4,500. So McDonald's worker, they got gifted, $100,000 from their parents. So they got $100,000 cash. As long as they got the cash, doesn't matter the price of the property.
They could be unemployed. They don't even have to work at McDonald's.
Oh my God. It gets better.
Yeah,
it does. I mean, look at how many investors don't have a job, right?
Yeah.
A lot of real estate investors quit their job. They don't have income. So when you literally fill out the application, we have a application that we customize on our end where we just blocked off the employment because we don't even want you to waste your time filling it out. Right. It's all about the performance of the property. So you mentioned a gift from a family member. DSCR allows you to get 100% gift. You just have to verify that you have some reserve somewhere that's your money to make sure we're not putting you in a bad situation. But I can't remember who it was. Someone said this a while ago. In real estate, anyone can be a real estate investor. It's hard to find the right deal, but if you find a good enough deal, you can find money or partners. And DSCR allows you to do that, because if you found an amazing deal and you go out and find a partner to do a, LLC where they take 60% ownership, you're 40%, and you're flipping burgers at McDonald's, right? Just get my order right. That's all I ask. But you can buy. I'm sorry. I went there the other day and they messed up my order and I was very and I don't know if they're trying to tell me to lose weight or not, but it's like I ordered a Coke and they gave me a Diet Coke. Like,
oh man,
no, I take it as an insult, So
Trying to help you with your belt.
Could I ask a question around qualification for like how income for the asset or property is determined? Because I feel like different lenders have different qualifications. What's like a general guideline? Because I know like some investors say, oh, I use like this software program, or, like, so how do you determine, I guess, rents? Whether it's like for like let's say short-term rental, because I feel like there's such a big range, and it's like, it could be the same property in let's say this neighborhood. They have a really good operator who's crushing it, and you have the one next door who doesn't know what they're doing, and it's like $20,000, $30,000 less in income. So how do you determine that?
Great question. So there's four main ways, right? Like all DSCR loans really get bought by the same investors. It's just a question of, do you have extended guidelines? Do you have basic? Do you create the guidelines, or do you get told the guidelines? But there's 4 ways that almost every lender looks at. Number one, which is my favorite and the easiest, if the property is currently a short-term rental, you just treat it as a business, right? Give me the last 12-month rent roll and I use that. And that's how you qualify. That's the easiest. I love it. Again, if you're buying an investment property and you don't ask for the last 12 months or 2 years, you're doing yourself a disservice if you're buying it, right? So agents listening, please always ask for your borrower that, because that's common sense. Drives me nuts. Number 2 is the most common thing, which is an appraiser can go out there and fill out what's called a 1007, which is a rent survey. The rent survey is going to look at comps, 3 to 5 comps for rent, and get an average, and there you go. Again, with the rent survey, they want the last 12 months if it's on rental, because that helps influence their numbers. Because even if 3 comps, in the same neighborhood do less, but you have actuals for 2 years that say you do X is still better than these 3. Mm-hmm. Then you have what's called Air DNA, which we won't get into how bad Air DNA has gotten recently.
Oh, it's bad.
It's awful. Like Air DNA needs to get slapped.
Yeah.
Air DNA can be used.
Listening, fix your stuff.
Yeah. And when you ask them, they say everything's perfect, because I've tried to ask them why they are terrible now. And so Air DNA you can use, but if it doesn't meet the qualifications, which most lenders need either an occupancy rate of above 60% or a market score above 60, right? I think when I was in school, 65 was an F, and they'll take a 60. So it's great because you can use those projections. However, it's also a great tool because if you're smart with it, you can do what I call game film approach, and you can find the comps within 5 miles, and you can find the comps, especially if you're a real estate agent, and you can help provide those comps to an appraiser to say, hey, look, here's comps in the area. This is what they do. Because otherwise the appraiser has to go out and find it, right? So that's called a cost analysis. The 4th way that hasn't been around that long, it's a little more expensive, but do I think it's going to be the future? I don't know yet, but the guidelines are very basic. It basically is a appraiser 1007 alternative. So all the guidelines state is if a form is provided by the appraiser that has occupancy percentage, ADR, which is average daily rate, and a monthly income, and it's provided by an appraiser, supposedly that's what they'll take now, because a lot of appraisers don't feel comfortable doing the rent survey on Fannie Mae's form anymore. So that means that there's opportunity out there where there's a lot of people, and I kid you not, you pay 10 grand for someone to run comps for you. There's companies out there that do that. Will appraisers soon start partnering with those companies and put it on their letterhead and submit it? We're working with the appraisal group now to try to beta test that to see if that's going to work. But $10,000 is a lot of money for a customer to pay for analyze your property.
Yeah. Nate, I have a question for you.
Okay.
On because I've come across this a lot out there. So in your big markets like Florida Panhandle, Orlando, Smokies, not a problem. Appraisers know what they're doing when it comes to the rent rolls. But when you come to places like, let's say, the Bourbon Trail, Kentucky, which is growing in popularity, but there's not a lot of data out there. Or even I did one in South Carolina the other day. And this appraiser came back. They came back with some ADR, and then only assumed it was going to be booked on weekends. I'm like, oh my God, where are they even getting this data from? So have you thought of any solutions in some of these markets where there are short-term rentals, but maybe not like the Smokies for those appraisers? Yeah. So sometimes it can be challenging to get those numbers. And so, yeah, hopefully maybe Nate and I can partner up and find a way to create some kind of database or somewhere to get some actual numbers. Cause that can be really tough. I mean, to find these, especially I just did, because I'm helping with our guidelines and with our DSCR investor, I sent an example. AirDNA was under like $30,000 to $70,000 on 5 of my properties, 5 of my personal properties. Under.
Yeah. I think that's a challenge. Like, it's there's every operator is so different, and like who the buyer is, like predicting, forecasting what they're going to do can really vary. And somebody who crushes it and you're in the 90 percentile versus, let's say, 60 percentile. I mean, there's a big range. And as an underwriter, I could see there being concerns as far as like staying conservative. But if somebody's trying to qualify for the loan and they're like being maybe more aggressive on the income, like how do you navigate that sort of situation?
Definitely. And the challenge with like the comps on AirDNA is that there aren't, the challenge is to just give it to the appraiser, is that there aren't addresses on those.
So, no, to answer your question, because I could hear all that, I just had that come up a month ago, weirdly enough, next to Auburn University. And all the appraiser did was, and I kid you not, this made me laugh. He went on Verbo and he reached out to anyone in the air, like who had rentals in the area, and said, hey, I'm doing an appraisal. Can you tell me what you've made over the last 12 months? And it was actually my client's property that's buying, who had a property 3 doors down. And he's like, is this really all you guys are doing when you can't find comps? And the appraiser said, this is what we do. We'll reach out to local owners. And hey, it worked. But on the fourth way, appraisers are getting more comfortable because you do what's called an STR alternative, and they do a market review. And nowhere in the guidelines, again, don't quote me on this, but it doesn't say you have to have addresses anymore. It just says it needs to know that you surveyed the area, you got the ADR, you've got the occupancy. So again, that's just been released recently in an extended guideline that we've added. And so we haven't had that come up yet because one of the first 3 ways always seems to work. Plus, most investors now are only buying properties that are already currently rentals.
Makes sense.
That's very interesting. But I'm going to tell you, for the listeners today, man, this is gold. I mean, you don't even need a job. You just need to basically own your own home, and you don't even need no money because you can partner up with somebody else for the money. So this episode today is going to let you know clearly that nothing should stop you. Get your credit in order. That's the one thing, right? We have to make sure you buy your own personal home and you get your credit in order. Get your credit in order. Find a property that's going to produce some money. Get in contact with Nate, the GOAT over here, and he's going to sit there and take care of you. No more excuses. I mean, I ain't taking it anymore. I'm done. So, I mean, when we go on tour, Parker coming with us, I think I'm done shirts because no more excuses. I'm done. And because listen, you don't even need a job. Nope. Do you hear me? I'm about to bang on the desk. You don't even need a job.
Can I ask a question on that too? Like, I'm trying to think creatively in my head right now. So are there any operators who are maybe they seek out like a fourplex or more multifamily, and then they're doing like whether it's short-term rental or even midterm rental, and with the midterm rental, is that challenging in underwriting incomes for that as well?
Midterm, yes, because it's not been around that long. So the guidelines from the investors basically are it's either STR or LTR, right? Because that matches the IRS. IRS usually looks at things 30 days or less or greater. So that's what the investors do. However, I will say when you refinance, it's very important to do things correctly with midterms because that means you can use the higher income versus like a market rent. So when you do midterms, you want to make sure you track it monthly because we just extended the guidelines where if you can show, out of a bank statement, you've received 2 months worth of midterm rent, technically, we can use that even if it's more than market rent. So it's very important that you document things on the refinance side because, it helps with the refinance. The same thing with, I know the trends that are going on right now. There's a few trends that are amazing and I'm jumping into one of them. But the one I want to mention is like what you see out west, right? Who was it? Lenny, you're out west, right?
I'm out east.
Oh, my bad.
West
Okay.
Coast is the best coast.
All right. So West Coast, I feel bad for them right now, but West Coast is doing a lot more by the room, right? You see Vegas, you see California, Seattle, Washington. So it's really hard to use those because it's by the room. It's a boarding house. There are ways to buy with a bridge loan. And then you refinance into a DSCR because you have a corporate lease versus treating it as a solo unit. So they do adapt with trends, right? We're working on one right now that's a trend that I'm starting to do with investing locally here. We've seen it across the country. We're working on seeing if we can extend guidelines even more to match this new trend, which should be very fruitful for investors. But we're working on extending guidelines even more to allow investors to purchase even easier with DSCR for these trends.
So could you name a trend or two that's like popping up or like investors are coming to you and saying, hey, this is a moneymaker right now, or it can be a potential moneymaker?
So moneymaker is by the room, right? There was a property movement. I talked to Movement about it. It was a 4-unit in Texas A&M, which we all know Texas A&M has way too much money. And people were paying a boatload per room to go to university there. But a market rent survey was showing like 1/5 the rent. So you easily buy the property, right, as a bridge loan, take it as a non-performing DSCR, and then you refinance after a year, 9 months, whatever, after you have the corporate lease signed, because the corporate lease will show like all the rooms together. That is one trend you're seeing out west. I don't think it's hit East Coast yet, but that's out west. The trend in East Coast that's going on is more creative financing with what's called lease to own, right? Mm-hmm. Lease to own is what I'm jumping into here locally because we have a need for it. It was big out west in St. Louis and some areas out there, but now in the Southeast, we're starting to do it where some people just can't qualify to buy a house, but they can pay a $3,000 a month rent. Well, investors are like, hey, if I get a 5-year lease, I'm guaranteed cash flow for 5 years. Why would I not buy an investment property knowing that it's a lease option for 5 years? And then they go out and find that property. That's what I'm diving into with building spec homes. So those are the two trends I see out west, of course, is the per room, and out east, we're seeing more lease options.
It's pretty interesting. I do have one question, and I'm pretty sure you guys answered this earlier, but I got to ask it. So what if you don't have a personal home? Can you get this loan, this DSCR loan, on like a fourplex in house hack?
DSCR is for a non-owner occupied. It's a great question. So you don't have to currently own a primary. You just can't be a first-time home buyer. The definition of a first-time home buyer is someone who has not owned a home for 3 years. Mm-hmm. So if you've owned a home, whether you're on title, mortgage, your spouse owns it, whatever, for at least 1 day in 3 years, you are no longer a first-time home buyer. Now, there are programs out there that will allow a first-time home buyer to buy, right? But usually that's 35% down. It's a risk because you've never owned a home before. We offered it up until 2 years ago, but we did away with it because there was just so much, I'll just say it, there was mortgage fraud. A lot of people would use it to buy, move in because rates went higher. They couldn't, cost of living went up. They couldn't afford with their flipping burger example any. So they used DSCR and then moved in it. You can still find them out there, but it's usually costly. But what you have as a solution too is bridge loans, right? Private money bridge loans. We offer one. You don't have to own a home. It's private money. You pay for it. You put the down payment. And as soon as you own the home for a day, you technically can refinance into a DSCR loan. But it's not primary. If you own investment properties, right, you're not a first-time home buyer. So you don't have to have primary housing history.
So Lenny, I mean, and maybe I could answer that like creatively. Find a partner who does qualify, and then you partner. And
of course.
there you go. You bring them. Somebody else brings the money, or somebody does a qualifying and figure out some percentages and make it work.
Yeah, it's like you said earlier. Nothing can stop you.
Nothing. Not a darn thing. I'm done. That's it. I'm done with these individuals. I mean, you know, we meet all these people and they say, man, I'm trying. No, you don't want to, because you haven't met a Parker. You haven't met a Nate.
That's right.
Because if you met a Parker and a Nate, then you will be in the game totally, 100%. There's no excuse. None. Zero. Done. Done, Omid. Done. I'm done, man. I'm done. This episode, we're going to promote this baby because honestly, people don't know this. And the thing about not having a job is still kicking me in the butt, you know, because, you know,
Lenny's done. He's done.
I'm about to walk out. I'm done.
So, I mean, we hope you have a job. That's just more security, but you don't need it, right? I hope you work. I hope you don't take this and quit your job and think real estate's get rich overnight, because that's not it.
Yeah.
But keep flipping burgers, y'all.
Well, and you know, a lot of times people will. It's also great for people who became entrepreneurs, right? Maybe they had a high-paying job before. Tech people that got laid off worked at Apple, Google, who knows, right? So a lot of these maybe have a lot of stock money or a lot of cash reserves or pileups. So, you know, or maybe here's a good one. I've come across a lot of doctors that sometimes a different management company will take over the hospital and they will change them from W-2. I had one that was W-2 for 12 years at the same hospital. A new management company came in and made them 1099.
Wow.
Well, guess what? Now they're self-employed. So if they want to purchase a home pretty quickly after they become 1099, an investment property, that's really hard to do. Now, once they've had the 1099 a little while, that makes it easier. But if they just switch to 1099, that's tough. So this is the kind of product that helps those as well. So yeah. Mm-hmm.
So Nathan, we may have you back to kind of like, you know, discuss and get a little bit more like deep into like the weeds and examples. But you know, what does Find Your Freedom mean to you?
I always live by the simple example. It means I don't have to worry about where my next meal comes from. But at the end of the day, it's really for me. If I want to take off work for the next 2-3 years and focus on me, family, or personal stuff, I have the ability to do so because I have an asset. You know, I'm not flipping burgers anymore. I have an asset that's going to pay me better than flipping burgers maybe. And while I'm taking time off, that asset is still appreciating, where if you take time off of work, you just lose money and you're not building anything. So that's freedom to me, is knowing I have a portfolio that is always growing no matter what I do on my personal work side.
I love it.
There you go.
So how can we find you? Like, you know, let's say we got some listeners. They're like, oh, you know what? I like this product. I want to talk to this goat over here. And I know you have the belt back there. They like your belt. You know, it's just like a total champ. So
I don't have a job.
Well, you might find me like flipping burgers because I got this Blackstone grill now and I'm learning how to do that.
Oh,
so
yeah.
Cooking's great. Yeah. So I am preparing for McDonald's, y'all. But you can find me. My videos always say just throw the bat signal up. I'm there to rescue deals. So you can do that, or you can hit me up on Facebook, Win with Nathan. On Facebook, Win with Nathan. It's just Win W Nathan on YouTube. LinkedIn, Nathan Gort, or of course you can always give me a call. I'm always around, and I'm sure if you can't find me, Parker probably could.
I might pass you on to him.
Awesome. Hey, this episode was great, but you know, we coming to a close, and this is when we're going to do our big boom session. So what I'm going to do is I'm going to count to 3, 1, 2, 3, and all four of us is going to say boom and hold it as long as we can. Give me some thumbs up and let me know you're ready. All right. Okay, so on 3. 1, 2, 3. Awesome. Check this out. We just had an amazing episode and I'm done. That's it. I'm telling you, the DSCR loan is the way. It's the future. It is here in the present right now. Talk to Nate, talk to Parker, because they can help you out. They simplified the real estate today. And honestly, I did not know any of these things until today. So I'm super educated and I want you to be educated too, in all seriousness. And when I say I'm done, I'm saying it in the best of manners, but there's no reason why you cannot get into this real estate game now. There's no excuses, nothing holding you back. So, like I said, talk to Nate. And also what we need you to do is leave us an honest 5-star review, because we need to bring more guests on like Nate that can give you all the information that you need to ensure that you can move forward in your real estate journey. And share this episode, because we don't like to hoard anything. We want to share with everyone. Share this with your brother, your sister, your aunt, your uncle, your cousin. Share this with all your coworkers, the ones that you like and the ones that you don't like. Until the next episode of Find Your Freedom, we talk to you soon. Peace.
Thanks for listening to Find Your Freedom. Be sure to subscribe wherever you listen to podcasts. While you're at it, please help us spread the word by leaving a rating and review and sharing the podcast with friends, family, and colleagues. Until next time, get out there and find your freedom.